I do think there are parts of the market that are run up a little bit, that have become a little bit expensive. As you know, when we create portfolios for our clients, we are customizing them. We are using individual stocks, so we're able to avoid some of those high flyers. We've been trying to relate to people a key message for this year, which is be careful of the trap of thinking that what you did last year is going to serve you well this year. Right? We are seeing a lot of asymmetry in stock performance that came out last year as the COVID hit different sectors in very different ways. And we think that the economic rebound that is coming in the second half is similarly going to have an asymmetric effect on stocks. So that suggests, perhaps going into banks, which really do well in economic recovery. But it also says, there are places in technology where you're still finding value, and where there's a lot of appreciation potential, and also some really good income stocks for clients, that are looking to their portfolios to generate income that they can use in their retirement. So it's a real lot of asymmetry right now that we think is going to be characteristic of the rest of this year.
So I mean, Joanne, I guess before I want to get into your stock picks, but I also want to kind of probe your mind a little bit about this. We've been talking about this notion that there could be a rotation, some kind of a movement, some kind of a transaction to move certain people out of the established good trade into new ones for a long time now, arguably fits and starts for the past 10 years. Why is this time different? Why can we expect some of those sectors to actually outperform at a time when the last decade it's been all about mega cap tech and communication services?
Well, one of the key reasons why this time is different is because of the nature of the shock itself, right? This recession, this massive disruption to stock prices was created by the pandemic, and that shut down services industry broadly, that really curtailed the economic activity in those industries. So the reopening trade is what's so very different about past cycles in the stock market and in the economy. And so what we see, right, is that the banks that really underperformed last year, energy really underperformed last year, these things do better when an economy recovers. And we think that in the second half, where we're going to see a lot of companies reopening, and we're going to see a much more sudden return to business than we have after past recessions. And that suggests perhaps not that same traditional sector reallocation or value versus growth, but really looking for the companies that stand to gain the most as those different industries reopen. One of them is the auto industry, right, which really got hurt as it shut down manufacturing during the pandemic and is now trying to ramp up production. It is really being constrained by some of the shortages over in the semiconductor industry, but that itself tells us how to make some good trades right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.